Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wujasek from Trend Spider. We have a
breaking news. What is up, everyone? Welcome back to another episode of Benzinga Live. Happy Tuesday. It's a Tuesday that feels a little bit like a Monday. It was Martin Luther King Day yesterday, so the markets were closed. Let's go ahead and get my Benzinga Pro pulled up, and we'll take a look at how the overall market is doing so far today, and then through some of the top headlines I've been watching today. Of course, you guys know over the weekend, or I've been following the news about Ryan Cohen's Baba stock. That's something I was excited about as a Baba shareholder. Talk a lot about that stock on the show. Of course, we'll talk about that story today. We will talk about Tesla trading higher again amid some new news about a lawsuit upcoming. But we had some new price targets this morning come out on Tesla. Jeffries mentioned a buy rating, but cut its price target. Stock is trading up 5%. Let's go ahead and get that Pro pulled up. SPY, we're looking down about 1.5%. Not terrible on the S&P 500. Qs basically flat. Your Dow Industrial Average is down more than 1%. So wow. So it looks like energy is trading a little bit in the green. Financials getting hit a little bit today. So the Dow is your laggard out of the major indices today. Rare to see that in today's market. Bitcoin, other top headline. Over the weekend, Bitcoin continued to show strength, crossing above the $21,000 level. Let's go ahead and take a look at this chart. Going on the daily chart here of Bitcoin, Bitcoin crossed above this 21,000 level for the first time since, let's see, here we are, January 13th, over the weekend, crossed that threshold. You have to go back now all the way to November, I think pre-FTX. I think, honestly, I mean, I'm shocked by this. I've been, kind of wary of not, crypto, not, I guess not as a whole, but a lot of individual projects, etc. I was shocked. I would have guessed that following FTX, Bitcoin would have been, at least going down to 10,000, if not lower. So this just goes to show you, I mean, sometimes when sentiment, when news, when everything is looking as bad as it is, sometimes it doesn't end up being as, bad as some people think. And the other example that comes to mind with that is Alibaba. When this was down at $50, I mean, even me, who has long talked about this stock, I mean, when Luke has been on the show, we've talked about how you can buy Baba here in size and look like either a genius or a really big idiot come, a year or a couple years. And only time will tell, but I had long been saying, hey, I'm willing to take that risk. And my thesis there had been, and still remains pretty much intact, and if anything has been vindicated throughout the past couple weeks, has been that, yeah, well, the situation in China isn't great. Yeah, China's proven that it's going to be more willing to, regulate its companies and crack down on certain things. Do I really think it's going to, the Chinese government is essentially going to run Alibaba? I think its biggest company, from what I can guess, it's China's biggest company, into the ground. And the answer is no, or my guess, my hunch, my thought is no, because China wants to compete with the United States in terms of being the economic power of the world. In fact, China's quite vocal about that. So in terms of that, and, I just think that I'm willing to take that bet that China doesn't essentially go full crackdown on Baba and its other businesses and just completely, destroy the stock. So I had been saying I'm willing to take that bet. I still hold shares of Baba. Shares are up now more than 80% from its lows in October. Of course, it got down below $60. But even me, when it was down there at $50, $60, really wanted nothing to do with the stock because it was like the sentiment was just so bad. I thought essentially that just, someone had to know something about China that I didn't or something, because the stock had just not gotten any love for a while, and Baba topped out well before other stocks. I mean, if you guys remember, the top for the market, the top for Bitcoin, for all these things, was November 2021, right? Let's look at a chart of the Qs. This top right here, or sorry, is November, December 2021. For a lot of growth topped out kind of the month before 2022. You know, if you look at a chart of ARK or a chart of Bitcoin, I believe even Tesla, or wow, no, actually, ARK topped out in February 2021. Wow. But still, I mean, ARK was still trading at 125 in November 2021. Let's check Tesla. Yep, November 2021. And going back to Baba, I mean, this thing topped out in October 2020. So this thing went on a crazy run throughout COVID. And it makes sense, right? Because Alibaba is essentially China's Amazon, among a lot of other things. So when when COVID happened and everyone was stuck at home, Baba's sales were going to go through the roof. People were buying the stock. But I think after a while, people started to realize that maybe the COVID situation actually in China was worse than in other places, or that the Chinese government was going to do more to fight COVID. And Baba stock has been just getting crushed since. I mean, this run from October to now in January is the best run Baba's had since really the onset of COVID. So it's been 2+ years. And then, let's go ahead and pull up this. We had a good article out last night about the Ryan Cohen. So activist investor Ryan Cohen has reportedly acquired a stake in Chinese e-commerce giant Alibaba worth hundreds of millions of dollars, and is privately nudging the company to do more share buybacks. Cohen and others built the stake during the second half of last year. So I wonder what, I guess we're over time when the filings come out, when we get the, regulatory filings from the SEC, we'll see actually Ryan Cohen's average share price and whatnot. But if they were loading up shares toward the latter half of last year, there's a chance they were buying shares for less than $70, $80, and they've already made, 60%. So for an activist investor, what that means is it means people like Ryan Cohen with a lot of money will come in and buy a sizable chunk of a company and then try to push whatever that investor's agenda is. For example, Ryan Cohen, when he made a sizable investment into GameStop, wanted to see GameStop become more, put more resources behind its e-commerce. So do more sales of video games online. Ryan Cohen came from Chewy, which was essentially making dog food online easier to order, and pet food. So he wanted to see that same thing happen with GameStop. Now he's taking on Alibaba and saying maybe he wants to see other things change in the business. I think for right now, his biggest, grievance, I guess, is that he wants to see more share buybacks, which is, now that he's already up 80% on the trade, or sorry, he's not up 80%. We don't know how much he's up. He could be up that much already. But we don't know exactly how much he's up. But if they announce more buybacks and the stock goes up even more, there's a chance he gets in and out of this real quick. And if you guys remember, the last big investment that Ryan Cohen made was in Bed Bath & Beyond, and kind of used it as a quick 1-2, right? He invested. Other people saw that Ryan Cohen invested, went out, bought the stock went up a bunch, and he was out. And I think a lot of people were really upset with Ryan Cohen for doing that. At the end of the day, when someone buys a stock or makes an investment, their goal is to try and make money. They want to see that investment go up. I would say for activist investors, typically activist investors like to go in and shake things up. I think Carl Icahn probably is the most famous, or probably to me, when I hear activist investor, who I think of, who, has had a long career doing so. What is Carl Icahn's newest thing right now is with McDonald's, I believe. What is I forget. I gotta look it up now to see exactly what he's. I know he's mad about he's mad about McDonald's treatment of pigs. But how could he? There's no way he bought enough I think this was the thing, is he bought like just the minimum amount to have a vote or something. All right, why Carl Icahn is ready for a proxy fight over McDonald's sources pork. Activist investor Carl Icahn is taking on McDonald's. So I know why he's, I mean, I get why he's upset, but I was curious about the actual investment. Like, how much does he own stock? Does he... I don't know. We'll do some more research behind the scenes on that. I do see our first guest hanging out backstage. We've got with us Bob O'Donnell from TECHnalysis. You know, a longtime analyst on the street, looking at, you know, covering different tech from cell phones, laptops, iPods, you name it. Talk to Bob about some new and exciting tech. We go through, I mean, every year, right? If you guys remember, I feel like, was it this time last year was the big Web3 everyone wanted to buy? I guess we could see on, let's go pull my Benzinga Pro back up. Web3 probably was the biggest thing this time last year. I'm excited to hear Bob's kind of hot takes for 2023. I want to know what's been the buzz with new tech. As long, if I get a thumbs up or something from Bob that he's ready to come on, we'll go ahead and give him our special intro and bring Bob on the show. Bob O'Donnell from TECHnalysis. How are you doing today?
Good. How are you, Arad?
Good. Good to have you on the show. Welcome to Benzinga Live.
Thanks for having me.
Of course, of course. So, I don't know if I did the best job introducing you, given your background. You want to go ahead and give our audience a brief introduction of who you are, what you've done in your career, what you've covered, and whatnot.
Absolutely. Thank you. So, I've been a tech industry analyst for over 20 years. I started my tech industry research career at IDC, big market research firm. I was there for about 14 and a half years. Left to start my own firm, which is TECHnalysis Research. Just celebrated my 9th anniversary, so into my 10th year.
Congrats.
I write for USA Today. I write for Forbes. I've got a column I do it for LinkedIn that also shows up at Seeking Alpha and TechSpot. I've written for a whole bunch of other folks. I'll do Bloomberg TV. I've done CNBC Asia. I've done CNN. I've done all of them. So I'm out watching big tech stories. I work with big tech companies. My business is specifically working with, your household names, everybody from the semiconductor guys through the carriers, through the device makers, through big software companies, all across the board, looking at some of the big trends, everything from 5G to robotics to AI to, again, the latest in semis. So I cover a broad swath of stuff, and excited to chat with you about, some of the big things I see happening this year.
Yeah, I mean, so, like I mentioned, in terms of, I guess, I assume, and correct me if I'm wrong, I mean, you talked about the semi names and the companies you work with, but do you like to kind of stick to the emerging tech and kind of what's hot and what's happening?
Well, look, I look at a bunch of things, and what's one of the interesting things, of course, is what's old is new again, in a lot of ways. For example, one of the biggest things, I think there's no question in 23 that we're going to see a ton on AI and machine learning. And, look, everybody's been talking about AI and machine learning and companies doing some of that work for, feels like almost 10 years, like for a very long time. But it kind of got old and it kind of fell into the background, and it was things you couldn't really see, touch, feel, what have you. ChatGPT, DALL-E, and all these generative AI things, these tools that actually generate content, are making, people's minds are kind of getting blown. And all of a sudden people are like, whoa, wait a minute. This is a radically different thing. And so there's all kinds of people thinking about what are the possibilities from this. And I'll lay out a couple different things I talked about recently in a column I wrote. So obviously, there's just the explosion of companies who are doing this. And, Microsoft is very wisely, by the way, invested like $10 million back in 2018 or 19 in OpenAI, the company that came up with ChatGPT and DALL-E. But now what they're talking about doing is obviously investing more. Actually, I think I said the wrong number. I think they invested $1 billion. I can't remember the exact numbers. Point is, they invested a bunch of money early on. Now they're going to take ChatGPT and other types of services, and they're going to embed them in Azure and offer that as a cloud computing service. And interestingly, rumor on the street is they're going to be incorporating it into things like Bing, their search engine, as well as other tools. Potentially they could do it in Office and other code development tools as well. And what's fascinating about that is, when you do a search on the web, right? What comes back? What comes back is a bunch of links. And if you really want to try and understand something, you have to go through and read all those links and kind of make sense of it. The beauty of integrating something like a ChatGPT into a search engine is you can say, hey, I'm trying to figure out something about XYZ topic, and it'll actually present to you a originally created, machine created summary of the most important information. That's really interesting for a lot of levels. First of all, it makes it much more useful. Now, it does change the advertising dynamic, because now all of a sudden I don't have to go bunch to whole different pages. I get a lot of information on one, but it really is kind of an interesting model. To be clear, there are a huge number of challenges. ChatGPT was based on a fixed time frame of information that it looked at. It's not updated dynamically. There's a lot of things that have to be overcome. But bottom line is things like that become very, very interesting. There's plenty of other topics. I'll pause for a second and let you say something.
Yeah, I think with Microsoft, just in terms of, I assume you've been covering Microsoft for a while, right?
Yes.
How big was it for the company? You mentioned that they're going to be lumping these things in together for Azure. Just Azure, Microsoft's footing as a player in the cloud space. How important was it for Microsoft to make that, strategic decision a while ago to say, okay, we're going to essentially, put a lot of resources behind our cloud department?
Well, it was enormous. If you really look back at the history, and again, I'm old enough to have watched some of the early mistakes of Microsoft. Remember that they missed the internet early on. They came very late with Internet Explorer and in terms of getting into the browser market, and then obviously evolved to Edge. They didn't want to be late with cloud. They were second to Amazon, but they've built up the second largest cloud business. And more importantly, they're thinking about how to adapt a variety of technologies into different places. Obviously, there's cloud. Office still generates a ton of money for Microsoft, and integrating more capabilities into Office becomes very interesting. Another thing people don't talk a lot about, but one of Microsoft's other areas that's quite successful for them is their development tools. If you are a software developer, more than likely you're using at least one piece of Microsoft software. And what a lot of people don't realize with ChatGPT is part of what it was trained on was actually code. It actually was trained on code, and the logic of code somehow, some people think, has influenced the success that it's having now in putting together logical arguments around a whole bunch of other different topics. Why that's important is because now we're seeing people use ChatGPT for actually improving their coding or speeding up the coding process. And even for what are called citizen developers, the low code, no code phenomenon. Again, this has been around for a long time, old news for some people, but it's never really taken off. All of a sudden, something like those kind of tools make the ability for people to create their own software, at least extensions to existing software, much more plausible. Because you can describe what it is that you want and then have the tool actually build it for you. And that really is quite interesting, when you think about it from a big perspective. Is it going to have a huge impact on their stock price? Maybe not. But I've tried to look at some of these major technology trends and think about their implications, hence that company.
Yeah, and the reason I asked that with Microsoft is just because, I even remember, I feel like, growing up, Microsoft was kind of, Apple was seen as kind of the newer, sexy tech, and Microsoft was, the older, more stodgy. And then all of a sudden, like over the last, really 8 years or so, like Microsoft stock has taken off, and you're just like, holy cow, like Microsoft's doing a lot of cool stuff with all their, what they're developing, whether, their investments in the cloud. And like you mentioned, OpenAI, they were an early investor in OpenAI. I saw Sam Altman, the CEO of OpenAI, is actually from my hometown in St. Louis, Missouri. It's actually
Nice.
weirdly, Bob, if you're ever looking to write some sort of like tech book, there's a weird hotbed for Jack Dorsey. Is from St. Louis. Jim McKelvey, the
What
CEO
part
and
of St.
founder of
Louis? I
Square.
actually have family down in St. Louis. Myself.
I So Altman is from like West County, where I'm from. I'm not sure on Dorsey and McKelvey. I know Altman went to John Burroughs, which was a school right near where I went to
Nice.
high school. But anyway, so it's interesting going back to the AI topic. So AI, which is C3A, not Open AI, but the stock, just ticker AI. I don't know if this happens to do with ChatGPT, but the stock's been kind of doing really well the past 3 weeks or so, really, ever since ChatGPT has come out and taken a storm. Have you seen a bunch of people out there being like, I want exposure, I want to buy some, whatever the next AI stock is going to be, since they saw how cool ChatGPT is?
I think there are a lot of people trying to figure that out, right? They're seeing this, back to your comment about last year being the year of Web3 and people figure out, all right, how do I get into Web3? Now you're going to see a whole bunch of people say, how do I get into AI? And there's going to, obviously, look, there's a lot of startups doing interesting things that may or may not play themselves out. But, it's important to not forget the big guys. I mean, the big guys are there for a reason. They got big for a reason. It's tough to stay on top when you're really big. But if you see companies who are innovating and doing interesting things, I think that's going to be important. Alphabet, obviously, there's a lot of talk about all the AI that they've had. In fact, one of the interesting things about this whole phenomenon is all of a sudden, for years, everybody's like, well, Google's way ahead, Google/Alphabet, way ahead on AI, right? Microsoft's way behind. Now, all of a sudden, it's like, oh, wait a minute. And so you hear a lot of stories about Google kind of scrambling to figure out, hey, how can we best leverage all the capabilities that we have and turn it into something useful. And so I think you're going to see a lot of play from all the big guys. And the implications go beyond just that AI software. Remember that a lot of this stuff requires super hardcore hardware too, and hardware accelerators. So back to the semi thing, companies like NVIDIA, which have been doing this for a long time. You've got a bunch of other little specialized semi players that are developing new chips. A lot of them aren't public yet, but there's a huge amount of effort right now in developing dedicated silicon specifically for AI. Even companies like Amazon, obviously, they've got their own AI accelerators as well. So you're going to see that. I think that's going to be another very interesting area. You just saw literally at CES, both Intel and AMD add AI accelerators to PC chips for the first time. We've had them in smartphones, ironically, for years. Qualcomm has had that, MediaTek to a certain degree. Now you've got Intel and AMD actually bringing it to the PC market. That's another interesting implication from this. So I think you're going to see this one filter out in a lot of different ways. It's going to be hard to capitalize on one specific area, I think, to be honest with you. But I think it's going to have this influence that ripples across tech, and there's going to be a lot of players to get impacted from it.
Yeah, that's it's interesting how, we're all looking at the ChatGPT and other AI, and a really like sound answer to how do you want to invest, or how could I get exposure, invest in the AI, could be, oh, just go buy some Microsoft, Google, and Amazon. It's like, oh yeah, I mean, 10 years, whatever, like you said, all these biggest companies, like if you think they're not putting money toward it, if they think they're not going to see Microsoft, willing to go the merger and acquisition route by, well, actually, no, they didn't acquire OpenAI, but invested into it. So now they have exposure there as well. And if you're feeling risky and you want to find, a more kind of startup-y in the AI, or one that's smaller, sure. But me personally, I'd probably rather just go with Microsoft and Google and Amazon.
Well, again, yeah, I mean, I think there's a lot of opportunities. Again, the big chip guys they're all in on it big time as well. NVIDIA, AMD, Intel, Qualcomm, all of these guys are, very much focused on doing this. AMD recently purchased, their ability actually came from their purchase of a company called Xilinx. Xilinx had some AI hardware accelerators, and they've integrated some of the Xilinx technology. That's how they're able to do it. So that's what I'm saying. Those kinds of pieces come around, from a lot of different places. And remember, look, we're going to see AI play itself out. Even though it may not be focused on fully autonomous cars, assisted driving, ADAS stuff is still going to be a big deal, and AI helps power that. You're going to see it in lots of other places as well. Everything from smart home and IoT stuff. Again, stuff that's been around for a long time. A lot of people are like, it's boring, but it gets a new life if these technologies are applied in an interesting and creative way.
Yeah, so Bob, I'm curious, and unfortunately we are running up on time here, but just going back to the chip space, if you had to pick, and maybe for like more of a long-term investment, not really a trade or anything like that, but just to buy and hold. And then, this isn't investment advice, but if you had to pick out of NVIDIA, AMD, or we'll say like TSM, which companies do you like in the chip space right now? Or do you think it doesn't really matter, can't go wrong with, NVIDIA versus AMD there?
Look, I think they're all going to do. I mean, obviously they had a brutal last year, right? I mean, it's been a whipsaw market in semis. We saw this incredible growth early in the pandemic. Then they got hammered as the market slowed down. But fundamentally, what these companies are doing is all very strong. And a company like TSMC, obviously, that's doing the manufacturing, you're still going to see demand over time. If it's a long-term play, which is I think about these things long-term, I think all of those companies have a lot of opportunities still long-term. And we didn't even get to VR yet, but we'll see what happens this year with that.
Yeah, I mean, Bob, I'd love to have you back on, really anytime, and we can talk more about VR, crypto, Web3, anything. And there's a million tech things we didn't even get to today,
yes,
but thank you for hopping on Benzinga Live today. I hope you enjoyed your first of hopefully many appearances.
Thanks, Arad. I appreciate it. Thanks for the opportunity.
Of course. Talk soon, Bob.
All right, take care. Bye-bye.
All right, everyone. That was Bob O'Donnell from TECHnalysis. I'll drop the link in the chat to that website if you guys want to check out more from Bob. Like he said, been covering tech for a while, so always good to get some experience on and talk about tech. Mostly what we're talking about in general anyway, so might as well get someone who's covering it as well. Speaking of, we're going to be talking more tech coming up in a minute here. So good show. Keep it rolling so far. We've got Paul Meeks from Independent Solutions Wealth Management coming up next. I see him hanging out backstage. So if Paul wants to give me a thumbs up or something that he's ready to come on, we'll go ahead and give him our very special Zinger Nation welcome and bring Paul on the show. Paul, how are you doing? Welcome to Benzinga Live.
I'm happy to be here. Thanks for having me. I love to see a tech show from the Motor City. I'm from Midland, Michigan myself.
Okay, yeah, nice. We're based in downtown Detroit here. We're right by Campus Martius. So, yeah, I mean, we're mostly stock, markets, everything. Although we do probably tend to talk more about tech stocks than anything else, just because they're typically the most exciting, right?
Yeah, me too.
Yeah, there you go. So, Paul, why don't you go ahead and just give our audience a brief introduction to who you are, what you do, what you've done.
Yeah. So I've been at it a long time. Got in the business in the mid-'80s, almost immediately after getting out of college. I've always been a buy-side equity analyst or a PM. I've probably covered the technology sector exclusively since I got out of grad school in 1992. So, of course, I've seen some gargantuan changes in the sector, both here and abroad. And I'm probably best known for running all the tech mutual funds at Merrill Lynch Investment Managers from, say, about the mid-'90s into the 2000s when that firm was sold to BlackRock. And at that time, I started those mutual funds from scratch, and we got up to $8 or $9 billion in assets under management purely in tech names and 6 funds that were not just US based, but some were based abroad.
Holy cow. So Paul, something I'm curious about, and before we get into, specifics about today's market and what's going on with tech, from just a general strategic overview, when investing in tech stocks, especially for a fund, I mean, you have certain returns you're trying to hit. I mean, where do you weigh like future growth opportunity versus what the company is doing today? Do you care more about what the company is doing today, or a company's potential for in the future?
Definitely in the future, because I think what they've done in the past and what they've done even in the present aren't really germane. We're going to be investing for at least 6 to 9 months out, and that might be on the short end of the stick. And of course, the other thing I think you have to do, and this has come home in spades this past year, is you got to be, if you cover the tech sector, a little bit of a economist, or specifically a macroeconomist, because the level of interest rates is uber important in investing in tech, right? A company could have a nice brand new bell and whistle. You could have supreme confidence that it's going to be a huge home run hit. But we saw with the valuations last year, when interest rates are on the rise, not just tech, but other aggressive growth stocks go down in a big way. And I don't want to say fundamentals don't matter, but I think last year we saw that you have to at least dovetail fundamental analysis with a view on interest rates, because I can't even get that bullish on tech almost regardless of fundamentals until you can tell me with some confidence when inflation subsides, and then more importantly with it, when the Fed stops raising rates. Right now, I think that's about May of 2023, but for better or for worse, that is the key deciding factor with tech stocks right now.
Yeah, and I mean, that's right now, I think, top of mind for most investors, whether they're looking more long-term or day trading, that the Fed, they say, right, don't fight the Fed. They want to wait until they see the Fed stop raising rates or even start cutting rates before they start buying. I've read somewhere, I haven't researched it myself, that typically in bear markets, not specifically tech, but just the overall S&P 500, typically bottoms out before the Federal Reserve actually starts cutting rates. Why would that be? Is that the market just getting ahead of what, anticipating what's happening?
Yeah, we always have to invest, as I said, at least 6 to 9 months out. And I think here's the rub. I think everybody agrees that the Fed will raise rates a couple of more times. I think that they get done with their business in early May. But then this is where the points differ. I think that the Fed will plateau those rates and keep them there for a year or more. Some people believe that they're going to turn around really quickly and pivot and start to lower rates. I think those folks might be disappointed. And so one of the reasons I'm not so bullish on the sector overall, I mean, there's always individual opportunities, is because I don't necessarily believe in that pivot. I think the Fed is going to plateau at a relatively high Fed funds terminal rate, at least into 04 and perhaps beyond. And so, yeah, that is the key factor. And hopefully over the next couple of months, we'll see what happens.
If inflation continues to trend lower and continues to normalize, knock on wood, or just continue what we've seen it do in the past few months, what incentive would the Fed have to keep federal rates that high? The way I see it, essentially, it would limit some growth of our companies, and if inflation is lower, then why would the Fed do that?
I think what happens with the Fed, and they learned from history, which was the horrible mistake that the Fed made by getting off the brake too quickly in the late 70s and early 80s. When you and I you might not have been around, but I was a much younger guy. And I think what happens is that the last CPI print, right, about 6%, we have to get down to 2% inflation, which is a huge gap between where we are now and where we need to be. So I think that the Fed will notice, as we all will, that inflation will continue to subside, but the delta from 6% to 2% on the CPI is a really big one. And I think the Fed will show some progress. Maybe we get the inflation rate by the end of 2023 down to that 3 or 4% handle. I still think it's going to be higher than they like. And for that reason, they will keep the Fed funds rate up, because they don't want to be the guys that turn around and pivot and then unleash inflation again. They want to make sure that they've really slayed the inflation beast, because back in that 70s and 80s, they pivoted too soon and the inflation came roaring back. And when it comes back the second time, it really comes back much, much worse. They don't want to be the Fed that does that again.
Yeah, I think the economists have dubbed that the 70s, 80s, that the stop and go policy, where essentially the Fed had to keep raising and cutting and saying, okay, now inflation's getting out of control, now unemployment's getting out of control, and they were trying to balance both of those mandates without ever really tackling either issue. And it just, well, really tackling the inflation issue, they didn't bite the bullet and just do that. So I agree that the Fed looks at these things in the past, and I mentioned this on the show last week. We talk about, the Fed doesn't really have that many, it's not a big sample size in terms of big bear markets of dealing with in the past. So when you look at, okay, an inflationary bear market, whatever, you do kind of got to go back to the 80s, last time you've seen inflation this high. So it will be interesting to see what happens. And I think there are probably a lot of retail investors that think right when the Fed stops cutting rates, the market's going to do what the market did during the COVID markets when we made new highs every single day. And I'm not quite sure that's going to happen this time around. And sounds like you're not quite so sure either, if you think the rates will stay a little bit higher for longer.
Yeah, I think that the terminal rate, which is what we call it, we get by the beginning of May up to 5 and a 5.25% range. I think they plateau it there at least for the rest of the year. And I definitely don't believe that they will turn around and pivot. The only thing that would cause a pivot is when we get to that May timeframe, if we've started what appears to be a long and deep recession. I think we will have a recession, but I think it'll be pretty short and pretty shallow. And so because the Fed does not want to take the chance that they're going to usher back in inflation, because that was a horrible mistake that they made back in the early 80s, that they will plateau the Fed funds rate, that 5+%, for at least a year or more. So please, if you're going to believe what I'm telling you today, don't believe in that near-term Fed pivot, and definitely don't invest based on that expectation.
Well, then let's get to that. Let's get to today's market. I've got the S&P 500 pulled up. We can pull up the Qs since we're talking more about tech here. But Paul, I mean, it's in your company's name, right? Solutions, independent solutions. What should I be doing with my money right now? I mean, when I get paid every 2 weeks, should I be putting part of it in the market, or should I avoid that until the Fed does cut rates? What should I be doing?
Yeah, here's what I think. Most people think that bonds are only for the old stodgy folks, right? But I actually think, going back many decades, probably to when I was in high school, and now I'm 60 years old, that we have, with the increase in interest rates, a pretty interesting opportunity in bonds. I know it's sacrilegious for a guy who's known for investing in tech stocks to say such a thing, but I think definitely conservative investors and maybe some aggressive investors should consider bonds, because you're going to be able to lock in 4 or 5% yields without much credit default risk. And then when interest rates tip and we ultimately do get to that pivot, you'll have extraordinary price appreciation in the same bonds. And we might have a couple of years in which bond total returns outperform stock total returns. And I have not been able to say that for about 40 years. So I think that's one idea. On the equity side of the house, I think we should continue to branch out from the States. There might be some better opportunities abroad. And even with this in the States, until we get a clearer view of how nasty this U.S. recession will be, I recommend people stay defensive. And that means invest not so much in aggressive growth stocks or tech stocks, but in utilities, energy, industrial, consumer staples. I still want to play it more defensively, even within U.S. stocks.
So yeah, I like that outlook, Paul, because you're a tech guy through and through. but you're a tech guy that's willing to see other opportunities when they arise and when they show themselves to be what you see as better opportunities than tech right now.
Yeah, one of the things that really changed me, I must say. So I was managing these huge tech funds when the internet bubble popped. And I went very quickly from being the hero to the GOAT. And I always said after that, not just for my career, but for the investors whom I serve, I always want to have a plan B. And the plan B is my dividend value model. And I have been actually focused on that one over the last year or so, actually since Thanksgiving of 21. And I still think that's a way to bet, at least for the next couple of months. I'll tell you what I'm really looking for as a catalyst in tech investing, because when I come back, I come back aggressively, is we know that quarterly earnings reports are upon us, right? So far, the only companies that have really reported in this cycle are the financials, including some of those big money center banks. The tech reports will come fast and furious in the next couple of weeks. And I think they're going to have some really nasty news, right? Even though Wall Street has very low expectations for revenue and earnings per share for most of these tech companies, unfortunately, when they get on the horn in about 2 weeks, they may drop the bomb on us again. Numbers may go down substantially again. And until we can find the low in these estimates, we can't really have a lot of confidence that our tech stocks have bottomed. So if we have over the next couple of weeks a nice cleansing where all these tech companies, particularly the marquee ones, give us some really bad information, and at that point, I'm convinced that even if we have a recession, all the bad news is baked into that stock, then I turn around and go the other way. But I think we're going to have another bloodletting of bad news over the next couple of weeks.
So you're saying, excuse me, Paul, that if this upcoming earnings season is, let's just say, horrendous for tech stocks across the board, and they all give bad news, and the stock, Amazon, Apple, Microsoft, they're all down 10% after their earnings, then you're more that's a catalyst that you might want to get in and start buying there?
Yeah, because
okay.
I have certain companies that I've identified that are the long-term faves, right? And the stock doesn't necessarily, even when they report, have to go down 10% the next day. I just need to feel confident that what they reported for the quarter and the guidance that they give for the next quarter, or sometimes these companies will give guidance for the full 2023, bake in a recession. Take the free pass if you're the CEO and CFO, lower those expectations to the floor, so then I can easily, like everybody else, step over that hurdle. Once I think that the numbers are low enough, then I say, you know what, man, I've loved NVIDIA. It's a long-term winner, but now I can finally get back in.
Yeah, I just love that, because anytime there is a really scary news on an earnings report, it's the exact opposite reaction that I give, and I think that most retail investors give, where they're like, holy cow, Amazon just said they're expecting their sales to go down 20% for the next 6 months. We got to sell. We got to get out of this stock, man. And then you do, and then it starts going up. So you want to take the opposite side, which I love. I love, people that want to take that contrarian
and
trades.
Aaron, another way you can play it, another tell, right? We're playing poker, and I'm giving you tells. One of the tells is, regardless of what Amazon or somebody else says, even if they badly miss numbers, but the next day the stock drives up anyway, tells you that people don't care about the bad numbers anymore. So you might have a positive stock reaction to crap, and that might be another tell to go back in.
Got it. Yeah. I've tried to look for little signs like that in the past before. That's a great tip, to where, when you start seeing something behave well on bad news and it's not making sense, you realize, okay, maybe that hit a price point where people don't care there anymore. They're willing to own that name at that price, and they can
and the
say whatever.
CEOs and the CFOs, dude, take the free pass, right? Kitchen sink it. And if you kitchen sink it and get estimates down so low that you start beating them again, you look like a hero. So anyway, I hope the CEOs and CFOs kitchen sink this quarter.
But is it crazy to think that that's the almost like part of it is that all companies and stuff are now planning for this recession and everyone's like cutting us, and it's like it's almost this like self-fulfilling prophecy. Everyone's planning for this recession. I mean, it's all anecdotal. Well, not even anecdotal, even statistically. I mean, spending has still been pretty good. Consumer sentiment's been rising. My buddies were just in Colorado for a ski trip this weekend saying everything was packed, 2.5-hour waits at every restaurant, so it doesn't sound like we're currently in a recession, and yet everyone is planning for what that's how I feel. Is it's almost as if there's this kind of like self-fulfilling prophecy.
Yeah, I do. And Aaron, I also think it's important to note that we have seen a ton of tech layoffs, right? Last year, we laid off about 170,000 people in the tech sector. And of course, the bulk of them came in that October, November, December timeframe. And so I think a number of tech companies, including some of those that already announced layoffs last fall, when they get on this conference call, they could say, we're getting rid of 5,000, 10,000, 15,000, 20,000. So the tech companies with these aggressive layoffs are telling you that maybe they're not as constructive on the forecast as the average Joe.
Got it. Yeah. And I think that has been a big concern. It's also, I think, been confusing, though, for a lot of investors, because they'll see the big headlines about Amazon laying people off, Tesla, the big tech companies, like you said, and there were a lot of them.
Yeah.
But then on the flip side, it's like every Friday or whenever the jobs reports come out, the numbers are better than expected, which is bad for the market because then Powell gets to keep rates higher for longer. And I think you just have all these things happening congruently, and it's kind of it's confusing for a retail investor. We have to take in all this information and not, basically decide what we think, but decide what do we think the Fed's going to think, and then the Fed's going to do, and it's just,
well, that's why I told you
things.
that a lot of people ask me about, products and services introduced by my favorite tech companies, right? That's the cool thing to talk about. Unfortunately, the thing that's been very important for you and me and everybody else to consider in this sector is the Fed. I don't like being a Fed watcher. That's not my shtick. But anyway, unfortunately, I have to do it.
That's what we're all doing. All right, well, Paul, unfortunately, we're running up here on time, but thanks for hopping on Benzinga Live today. I thought it's been a great discussion. I'd love to have you on again in the future if you'd be willing to come back on.
Oh, I'd be happy to do it, man. I wish you awesome 2023.
You do the same. Yeah, we'll get you back on here in a couple weeks or so.
Okay, dude.
All right, have a good one, Paul.
Bye.
All right, y'all. That was Paul Meeks from Independent Solutions Wealth Management. I'll drop a link to the chat in that. Cool dude, Mr. Paul Meeks over there. All right, I do see our next guest hanging out backstage. I've got Professor Bierman with us, CMT. We're going to be talking some charts. If we get a thumbs up or something that Professor Bierman's ready to go, we'll go ahead and give him our very special intro, bring Jeff on the show. So without further ado, let's go ahead and play that special Zinger Nation intro. Professor Bierman, CMT, welcome to Benzinga Live.
Hey, Aaron, thanks for having me, especially on short notice. But I found time to squeeze in today in between teaching classes and whatnot. So thanks.
Beautiful. I'm getting an echo. Is there a chance you can turn the volume down on your end, or a way you can still hear me?
Yeah, let's see if I can do this. Hold on 1 second here.
Let me see, too. There might be a...
I did an echo cancellation, if that works.
Let's try.
How's
Yep,
that?
sounds like that's working. All right, awesome.
Okay.
So before we get started, I mean, I personally know what a CMT is, of course. I don't need you to explain it to me, but maybe there's some folks in our audience that might need it, and I might need a refresher as well.
It's 3 levels of hell. It's the chartered market technician. It's akin to the CFA, which is the chartered financial analyst. That's fundamentals. This is technicals and charts. It's 3 different levels of trying to prove your proficiency and expertise in every form of technical analysis possible, including programming, old technical analysis, new technical analysis. So it's very hard to earn. I earned mine about 7 years ago. The year I took it, there were only 10 people that were accorded the designation worldwide. It's far more hard to come by a CMT than a CFA. The curriculum is much more difficult.
Holy
Nevertheless, once you
cow.
earn it, though, it does not guarantee you make money, Aaron.
Do you know all the other CMT holders out there?
There are
It's a small club, right?
Yeah, I think there's only like 1,700 worldwide. Versus
Do you guys have like big events, meetups, anything?
Sometimes we have, there are meetings, there are local chapters around cities, and there's 160, 70,000 CFAs. That's not to dilute the importance of it and the prestige, but the CMT, it's a different animal and a different level of proficiency.
But there's no one big event where all the CMTs gather?
Just once a year.
Okay.
You get together and it's usually in New York City where the headquarters are of the CMT Association. You have a dinner, you meet people, you have people having white papers discussing about the latest developments and whatnot.
Well, maybe we'll do a Benzinga CMT or technical analysis event and we'll get that going.
Go for it.
All right. So you're into, you got the charts, you basically got a degree in charts. Can I say that?
You can say that.
All right, so if you got a degree in charts, what are you seeing right now, just in terms of, I'll pull up like the SPY on a daily. Are you liking what you see? Are you not liking what you see?
Well, here's the thing. You're showing me a chart of just candlesticks.
Okay.
I don't trust candlesticks. It's like an illusion, like Houdini. Candlesticks can lie or they can tell the truth. What I do is I mix and match different sets of indicators against candlesticks to validate or to invalidate what I'm seeing. And one thing I'm seeing currently is the market is not that overbought, which means it could trend higher up to about the 4,150, 4,300 level in the current situation. But the problem is that you're looking at a product, Aaron, of 500 individual constituents, right? The S&P, the SPY. The problem is the SPY is being only driven by about 30 or 40 stocks right now. So if you remove those 30 or 40 large cap stocks, which skew the average, the S&P is actually below 3,700 and driving lower. So it's a very thin line holding up the market in terms of market breadth right now, mainly in three sectors: consumer staples, oil, which justifies because the valuations are very, very compelling. And the third behind that is certain what I call like off the hook things in leisure. So what I call like Hyatt, hotels, lodging is holding it up. Let's say Royal Caribbean Cruise Lines, a lot of the leisure stocks are holding it up. But absent of that, the market would be actually a lot lower because of the underperformance by the preponderance of other sectors. So be careful how you trust this.
So you would like to see essentially better market breadth, wider strength throughout the market, not just the biggest name, Apple, doing well right now or whatever. So, and by the way, and I know we were short notice today, you are able on here on our platform that we're using to stream to share your screen. And again, if you're unable to today, that's fine. But in the future, if you would have charts you would like to show, by all means, we would love that.
Sure, absolutely. Invite me on again. I'll have a whole setup for you. Market breadth needs to be better, but it's more than that. There is a bifurcation in the market. And I listened to your previous guest. He's spot on interest rates. He's spot on in explaining how interest rates impact technology stocks. He's dead on because I come from the same era he comes from. He's also spot on with trying to shift more towards fixed income because the yield is more compelling than the S&P. But if I may add like a dimension, I don't think he quite integrated into this.
Of course. Yeah, piggyback.
A lot of growth stocks are now trading like value stocks, Aaron. And I mean, like, for instance, Intel, Micron Technology, trading at their lowest valuation metrics in 30 years. You haven't seen this low in 30 years, okay? On the flip side, you have defensive names, consumer staples that are trading at their highest valuations ever. So there's a flip-flop. It's like a crossover. Growth trades like value trades like growth. And until that bifurcation is rectified, the market just can't seem to get out of neutral. You need to get the growth stocks to start picking up and stop trading off of charts, because charts are momentum based, and start getting some of the value stocks to take off. So we're in a bubble and a lot of value. Pepsi's a bubble, Coke's a bubble. They're all trading at 26, 27 times earnings. Whereas you look at Intel and Micron trading at single digit multiples and you scratch your head, because eventually Micron and Intel are going to turn it around, get their normalized long-term growth rate 15 to 20%. And Coke is never going to grow more than 10% from now until the end of time. So the market is basically trading off of what I call the handbook of sector rotation, which is very dangerous because it doesn't factor in valuation. And with interest rates going higher, that's where valuation starts to really come into play. So I needed to add that dimension that your previous guest did not kind of mention.
Yeah, that's an interesting point. I mean, I think you take a look at, you know, companies like Coca-Cola or Chevron that are trading at or near, you know, their all-time highs, and you like step back and you really ask yourselves, like, do I think this company is really going to be growing that much in the next 5-10 years? You know, whatever. What'd you say about Coke? You don't think it's going to grow more than 10% throughout the rest of its history?
No, they can massage their earnings and manage their earnings, Aaron. But honestly, for Coke, Coke grows with the demographic of the world population. That's what it does. And so Coke grows at 2%. You know what they call it organic growth. That's sales. Earnings might be 5 to 7% per year. So it should trade along a multiple of maybe 10 to 12 historically. It's trading at 26 times earnings. And the reason that it's being doing that is because when people are uncertain, what do? They just buy the names that they know that have what's called steady cash flow, steady dividends, what they can count on to be what's called anti-lumpy earnings that are non-cyclical. And that's dangerous because it assumes that it's priced correctly just because it's Coke, when actually it's detached from its intrinsic valuation. And it's not just Coke, Aaron. There are dozens, Starbucks, Pepsi, Keurig, Dr. Pepper. There's a long line of these. And what managers often do is they flock to these for safety, for yield. And they're flocking away from them because they think we're in a recession. But again, that's a dangerous type of approach because it disincludes valuation into that mindset when you're looking at them and you're just trading them for rotation and cyclicality and seasonality. And that's a dangerous path you're taking.
Yeah, I mean, it's an interesting point. I think, you know, does that mean necessarily we'd have to, or we not have to, but we would maybe see some of these names like Coke or some other names you mentioned like come down, or would they just maybe start trading sideways while the growth stocks start catching up?
Fantastic question. If I had the answer, I'd be a billionaire.
Okay.
No, I honestly, not to be facetious, honestly, it may trade sideways for a while. And then finally the bottom gives out, or there might be a rotation of funds, a source and use of funds where money comes out of Coke and Starbucks and finds its way back into stocks that have imploded. I'm with your previous guest. NVIDIA to me is not cheap enough, but it's getting close to that floor value. There's much more upside in NVIDIA from here than there is in Coke in terms of growth and valuation expansion. So I look at Chevron, and Chevron's not that expensive. Neither is Exxon. I mean, they're trading at single-digit multiples. That's in line with their historical multiple. So I don't think that Chevron's even close to being a bubble. I don't think that's going to come down all that much.
But what about if you could say that, I mean, like gas prices were, you know, they put up historic quarters the last, 2-3 quarters, and now that gas prices are lower, if you anticipate those numbers to come in a little bit lower?
Even if those numbers came in lower, the valuations aren't excessive. So there is a seasonality effect where, there's a pop one quarter and a pullback, you know, depending upon when we pass through January and February, and there's the airlines. You have to factor this all in. But even if they miss or they beat, it's just not that expensive to own these oil stocks. Schlumberger, Chevron, Exxon, you can go through the whole list. They're not trading at these what I call like nosebleed multiples. But you look at other sectors and they just simply haven't come down enough for me to feel like, okay, we're going to get participation from all 11 sectors, all boats lift the same tide. But your guest nailed it. The semis have been crushed. They've overshot their orbit so far to the downside that the more bad news comes out, the more I want to buy them. Because eventually they hit those floor valuation levels and the market fully prices in and discounts that news for a year or 2 years out. So no matter what they report, it's already factored in, so there's nowhere to go but up from here.
Yeah, and I mean, I think it's important for, you know, you look at names like NVIDIA, or NVIDIA's up another 3% today. NVIDIA's now up, and here, let me get pulled up on my screen here. From its lows in October, got down to about 110. It looks like maybe a little lower than 110. is up more than like 50%. So I think there are a lot of people that are like, oh my God, it's moved so much so quickly. I can't get in on this on the upside. And to, I think your and Paul, my previous guest point, there could be some more clouds in Nvidia's sky in the short-term future. But even when you zoom the chart out, I mean, you look at it, it's still, you can tell, like, you're still beaten up. I mean, granted, these were probably, you know, a little bubbly the way we got all the way up there, sure. But even though we're up from the October highs, we're still beaten up from the levels we were trading at, whether it was last year or even the, you know, year before.
Yeah, I technicals are a big part of what I do. It's all about risk reward, identifying patterns and whatnot, and trying to anticipate, like, okay, if I'm wrong with this trade, what might be the downside versus the upside? When it comes to Nvidia, it looks like we call that in my business a round trip. It returned all the way from where it started a few years back. And that's just realigning its valuation metric with expectations. And that's a good thing. But don't just assume because NVIDIA has come down this much that technically it looks palatable, but it's not really a great buy. It's what I call bargain hunting versus bottom fishing. It may look like bottom fishing here, but the bargains aren't still there. There's still a lot of other bargains in many, many tech stocks outside of NVIDIA that may be overlooked. A lot of people look at this and they think, oh my God, it's what they call a three bagger, Aaron. Oh my God, if I can get this and it can go back to its high, I make 200 or 300%. Well, sure, as long as what happens, as long as it gets tailwinds, as long as the value can expand, and as long as the ship is righted in the industry with the inventory rebalancing and growth demand going forward. But if that doesn't happen, okay, don't look at the technicals as predictive. Technicals are not predictive. All they do is they map volatility. They show you where you are, where you've been, but they don't necessarily tell you where you're going. But what they do is they help you identify key gravity points, key support, volatility up and down. That's how I use them. But I don't look at NVIDIA and say, well, if I buy today, it might go to 300. Sure, but it depends upon a lot of other factors that fall into place. Be careful with that.
Yeah, and I think that's a great point. And I was kind of making that point to other people a month or two ago. People were reaching out to me basically being like, oh my God, Tesla's down 50%. And I was basically looking at the chart and looking at the stock and saying like, yeah, but it's the PE is still, 40 or 50 when the Fed's still raising interest. Like, I don't want to own, why would I want to own the name that still has a high valuation in this environment just because the prices come down? Like, that didn't make sense to me. So I think that is a good point. When you're looking at the chart, just because something has come down a lot doesn't necessarily mean that it's reached that floor of value or that it's a good time to start buying it.
I could not agree more. I was going to reference Tesla, so you stole my thunder, but you're absolutely right. And it's not just Tesla. There's a lot of other stocks out there where people are thinking they're compelling buys just because they've come down. And there is also this bifurcation in a lot of individual sectors. And what I mean by that is simply this. You look at stocks that have been tagged in retail. Some of them have just been blown out. I'll give you an example. Macy's, Nordstrom, Kohl's, KSS. All these stocks have been decimated, and rightfully so. Why? Because the earnings fell off a cliff, because interest rates went up, the cost of buying off of credit cards went up, people are getting laid off. It's all a part and parcel of the retail cycle. So that makes sense to me. But the thing is, they've overshot so badly that they come in at like 6 and a 7 multiple. And I'm like, I've been doing this business as early as Paul Meeks. I've been around since the 80s here, and I'm a fossil. You don't see multiples of 6 or 8. The guys like David Dreaman and Peter Lynch would buy those companies outright and own them and take them private if they saw things like that. And yet the market keeps poo-pooing them. And at the same time, it'll say, well, let's go out there and buy that Walmart. Well, Aaron, Walmart trades at 40 times earnings. And they'll say, let's buy some Costco. Costco trades at 30. These multiples are so detached from their story. It's remarkable. So what people are doing is they're thinking to themselves, Aaron, it's called in technical analysis, if I may, without being insulting, it's called affectation. Affectation means you buy based upon how you feel and not based upon the numbers. So people are like, well, this is Costco and I shop there a lot, and Walmart's high visible and high, one of the 20 largest companies. So they buy based upon safety and how it makes them like a warm hug, but they don't really dig into the numbers. So Costco's got nothing but downside from here to me, and Kohl's has got nothing but upside. But the market doesn't want any part of this. The market's like, well, we'll give Costco a 35 multiple and we'll give Kohl's an 8. Well, my question to you is, and I don't have the answer, is how long is this going to last, the bifurcation between these multiples? Because they should be more in line with like, a 12 to a 15 handle. And that's where I have a problem with the market overall. Some stocks are ridiculously cheap, but their market caps are so small they make no impact. Other stocks are ridiculously expensive and their market caps are so huge that they take up a big part of the S&P. And that's one of the reasons why the market hasn't imploded. The largest of large cap have not given way, and that can sort of fool the average person who watches the index. Warning, know the constituents.
Yeah, I mean, and that's a good point. I think that's become more of an issue, or I guess depending on how you look at it, but it's just become more of a phenomenon, I'll say, over time, that the biggest names in the S&P have had such a big weighting of that index. And I think historically, if not the biggest, weighting of the top 10 ever, then very close to that. But yeah, so Jeff, I mean, in terms of looking at the Costco, you mentioned the retails that have been beaten down. Are there other value names that have been beaten down so much? And then also, what do you think are the chances that, I think going forward, like, I almost feel like growth investing is now going to kind of become the norm, or maybe it already has, whereas value investing is going to become more and more. I mean, I'd assume 30 years ago, like the average person's stock portfolio, not just overall portfolio with their bonds and stuff, but just stocks, had a bunch of, dividend paying Cokes, those types of names. Whereas now it might be more techie companies. Do you think maybe growth is just going to be kind of the go-to for whether it's retail or even institutional going forward?
I think that we had a psychological shock and awe reset last year. I think the days of picking up a smartphone, logging into your Robinhood app and pressing a button and making money automatically, I think that's over. I think people are going to realize that you can't trade 100% off of technicals anymore, or what you hear on news media outlets. You need to actually do some due diligence, dig a little bit of fundamentals into these companies, and start to realize that value does matter, even if it's a growth stock, Aaron. Value does matter in a growth stock, because at some point the growth becomes unsustainable and the stock then does a mean reversion and corrects. So absolutely, I think value is making a comeback. I don't think value will ever dominate, but I can tell you this. History has shown that over the last 100 years, and this is from the French and Fama, study, that in the end, all paths lead to Rome. And what that means is, if you start with the growth stock and you start with the value stock and you hold them both, Aaron, at the end of 90 years, the returns will be identical. That the growth gets ahead of itself, mean reverts to a value. And the value itself is like the tortoise and the hare. It just stays steady, slowly growing for many, many years, and eventually ends up at the same destination return as the growth. So I think people are going to start to realize that, hey, you know what? It's okay if I buy value, because if I'm a long-term investor, it'll still end up in the same place that the growth will be, just it will take a little bit longer period of time.
So you're a believer in the idea of I guess, some sort of reversions to the mean in the market, right? So if I like that. I think that it makes things maybe a little bit easier to understand if you look at that holistically, that, okay, all these things are going to cycle back to somewhat even in the end.
Aaron, I could tell you this. Statistics never, they say, Mark Twain says, there are lies, damn lies, and statistics. But I can tell you this. Statistics in the long run rarely, if ever, lie. In the short term, you can spin them. But in the long term, they all come to a same type of average. The average return on the S&P for 100 years was about 6.5%. The yield was 2%. That's an 8.5% return on the S&P for 100 years. So when you're starting to get 20 and 30% returns, you're starting to get sugar plums, and you're just dancing out of reality. Because at some point, that 20% has to mean revert to 8%. And if you have years of underperformance, Aaron, it actually works out really well, because now you can start to buy and feel like you have the edge to the upside of the mean reversion to the upside. So statistics does matter in this business, absolutely.
Yeah, I mean, I think if you look at what 2020 was, I don't even know. Off the top of my head, I'll just say the S&P finished up 15. And you look at last year, 2020, I don't even know what year we're in anymore, but 2022 was we were down negative 13% on the SPY. you compare that to what we were up the year before, it probably evens out to about, I don't know, maybe a little less than 5 or 6%. Well, either way, the point stands that as good as it was in 2020 and 2021, in reality, it probably wasn't that good as we were making it out to be, because what was next was that big drop. And as bad as we were making it out to be in the depths of where we were at even a few months ago in October, it's probably not that bad. It's probably not like we're going to go down 15% on the S&P every year. So that's an important thing to keep in mind.
We had 12 years between, the bull to the bull that ended last year. 9 of those 12 years we were up. We were down back to back 2 of those years, but they were almost negligible. So what I'm telling you is, hey, 9 out of 12 years is up. It's fantastic. If you have 2 or 3 down years, it just falls in line with normal statistics. So, roll with it. If we end down 20% this year, it's not the end of the world. To me, the lower we go, the more chance we build a bottom and find our way back to the upside. So look at down periods as opportunistic. Don't look at them and turn your head and say, this is terrible. It's great. It's opportunistic for you to make, risk reward falls in your favor. Absolutely.
Beautiful. Well, Jeff, I mean, I know we're running up on time. You've got other classes to run to. It's 12:45. So thank you for hopping on Benzinga Live with us today. Where can folks find more from you?
A few places. You can look me up behind me, TheoTrade, www.theotrade.com. I also have a site called www.thequantguy.com, where you can see my irreverent calls in the market, which are way off of base. And then, of course, you can always look me up on LinkedIn. I teach at Loyola University Chicago, 6 different classes, and I teach at DePaul University a couple classes, but I've been on sabbatical for a while there. But I got to teach a Loyola class in an hour, so thanks for having me on.
Yeah, of course. What class are you teaching at Loyola?
I'm teaching corporate finance. I teach many types of investment finance, applied portfolio management. It runs the gamut. Grad school, undergrad, and MBA executive. So I'm all over the place.
There you go. There you go. You sound like a busy guy. Thanks for taking time out of your day to join us on Benzinga Live. Everyone smash the like for Professor Bierman, CMT. Got those links in the chat. We got to get you on the show again soon, Professor.
Anytime, Aaron. Thanks. It's an honor. Take care.
No problem. You as well. All right, guys, that was Professor Bierman. Again, visit those links in the chat, thequantguy.com as well as TheoTrade.com. Thank you, Professor Bierman, for joining us today on Benzinga Live. We've got to keep it ticking. I see our next guest hanging out backstage. Chen Arad from Solidus Labs. We're going to be talking some crypto with Chen. Excited about that because we've seen some, got to give it to the Bitcoin and Ethereum. People were telling me you got to be buying a few months ago, and I wasn't. When Bitcoin dropped dropped around 15,000, when Ethereum was at 1,200, I actually did. I might have. All right, hold on. Well, actually, we got to bring Chen on because I've had him waiting for too long. Chen, give me a thumbs up or something. I'll give you the special intro, and then we'll. All right, Chen's ready. Let's go ahead and bring one.
Hello,
Mr.
hello.
Chen Arad, welcome to Benzinga Live. How are you doing?
Great. Pleasure to be here. I'm a fan. Thanks for having me. I hope I'll be able
Of course.
to keep up.
Yeah, I'm a fan as well. Thank you for coming on the show. So before we get started, why don't you just bring us through Solidus? Am I saying that right? Solidus?
Yes. So first of all, it's a bit confusing. My name is spelled Chen, which I'm sure is very confusing for folks. It's actually Israeli. It's pronounced Chen. We have those biblical sounds in our language.
Chen.
But it's not on you. It's very confusing for many. And Solidus, yes, you pronounce it correctly. The Solidus. We named the company, by the way, after the Roman coin Solidus, which was all the rage in 1312 and ended up being used for a millennia on 3 continents. So we thought that was fitting for a company that specializes in enabling crypto's potential by mitigating its risks. Specifically, Citigroup named us about a year ago as category definer for crypto market surveillance. We specialize in various things, but our claim to fame is preventing market manipulation, price and volume manipulation, all the way from wash trading and spoofing in crypto markets to much more kind of sophisticated and new things in DeFi, in the intersection between CeFi and DeFi.
Yeah, so I assume since the FTX fallout and some related fallouts, there's been more of a need or more of a want for companies to kind of know that their crypto is safe, or to know that their crypto business, what they're doing transaction wise, everything's going to be safe. What have you guys seen an uptick in interest in the business since that?
Yes, I think it's important to say, obviously FTX is on everyone's agenda, but it's important to say that we've been seeing an increase for years now, way before FTX happened. Being kind of very honest, the roots of our company are at Goldman. So, most of our leadership team, my co-founders, et cetera, come from Goldman's equities trading technology desk. It was clear to us that over time, the need to mitigate risks is going to be critical for crypto to actually be usable to reach institutional and mainstream adoption. And but I will say, 5 years ago, when we would say crypto market surveillance and preventing crypto market manipulation, we would get raised eyebrows. People would look at us sometimes a little bit weird. Now there's no question, and over the years it's become a standard. To succeed in crypto, you have to work with regulators. You have to show your clients that you're protecting them, and specifically, you have to demonstrate market integrity, which can be much more challenging in crypto for individual platforms, because even if in CeFi the trading can resemble order books and how it works in traditional finance, the assets are decentralized, meaning they're traded in a lot of places at the same time, meaning that proving that the prices are healthy is a different kind of challenge. So there was a long answer to say, yes, we've been feeling an uptick for the past 5 years, and increasingly over the past few months, where I think there's no question that being compliant, working with regulators, being transparent about how you keep your clients safe is a critical competitive advantage for crypto platforms. That's how I believe increasingly people choose to invest, both retail investors and obviously institutionals.
Yeah, and so just throughout the past couple months, and I guess zooming in on the past couple weeks, really, seeing the price action of Bitcoin and some other cryptos start ticking back up higher. Have you seen people, or been hearing like in the industry, that people are starting to feel a little bit more at ease, or is there still the same amount of uncertainty as there was a couple months ago?
The answer to that question has a lot of layers. It depends, who you're talking about. I think that for people like me, who've been in the industry for 5 years, who are here for the long-term value that crypto has already demonstrated it can bring to financial services. And by that, I mean inviting more people to invest, making it more accessible, creating more liquidity in formerly illiquid assets. And those are just a few examples. We knew there are ups and downs. We've been through, the 2018 crypto winter, where crypto was much smaller. It was actually a real concern. Is it still going to be here in a few months? So in that sense, within the kind of core of the crypto community, people who are not opportunists and are here to really build it, there wasn't the kind of panic that you saw 2-3 years ago. There's a recognition that it's a huge setback in terms of the prospects of further adoption, and that there's a lot we need to prove on how we enable the potential by mitigating the risks. I will say that there has been a kind of, if you look a bit broadly from that circle of the kind of crypto natives who have been here for a while and are here for for the long run. Obviously, a lot of people shied away from crypto for the past few weeks. While obviously nothing I say is investment advice or legal advice, my kind of part of my interpretation of what's going on right now is that people are realizing it's not going away, and the natural interest that always existed, is starting to show in the markets. That doesn't necessarily mean I think it's going to continue to go. I think there's a lot of ups and downs. There are a lot of regulatory developments that we're expecting this year. I'd expect some more downs before we see a big up. But generally, I think people in the industry are pretty confident that this is just an opportunity to optimize, even though we're all very upset about what happened. And then I think the last few weeks kind of represents that confidence expanding to slightly broader circles in terms of the climb in prices of some of the core assets.
Yeah, I think that it makes a lot of sense, right? That, like you said, a few months ago, people really had like the fear and uncertainty, like, is this industry, are we going to be around in a couple months, like whatever. And now people have, I think, started to, even if there's still uncertainty, that there's now maybe a little bit less fear. And I think that's important in terms of just people willing to open up their wallets and buy some Bitcoin or buy some Ethereum. Because if you have all that fear, you're going to be less willing to do so.
Yeah,
Um,
100%.
yeah. So, what are you excited about in terms of 2023, 2024? You know, are you excited about things on the technological front from crypto, or more so to see more, you know, regulatory advancements made maybe here in the United States or also just around the world?
There's something exciting about even though no one is ever happy about a crypto winter, there is something exciting about it, and that is that's oftentimes where where mistakes have happened. That's kind of usually mistakes have happened, overhype has happened. That's usually what leads to a winter. And during the winter, there's a bit of a cleanup of the market. So, the projects who aren't necessarily, you and the professor were talking about, the return of, of fundamental value. The projects that had less of it usually don't stick around. People who have more faith in the industry, not just based on hype, but based on, it's, much broader opportunities, like its role in enabling Web3, etc. So there's a return to infrastructure and to stability and to fundamentals that, to me, as someone who is one of the co-founders of an infrastructure company, is very exciting. I believe that's when, I'm sorry for the cliche, but there's always the story about the gold rush and how the people who who really made the money are the ones who planned for the long run, invested in infrastructure, kind of really studied the opportunities. So I feel like that's often, bear markets are oftentimes when that happens. That being said, a lot of people got hurt. That's not something that anyone in the industry takes lightly. And in on that point, I would say that there's a lot of excitement, which is so contradictory to where the market was 5 years ago, about regulation. You asked about it, Aaron, right?
Yep.
So it's funny. I have to admit that more or less every year since 2019, when the new year started, there were talks about how that year is going to be the year of crypto regulation. I think that this year is going to be the year of crypto regulation. I think that there's a sort of like a perfect storm of a lot of bad things that happen and demonstrate that the majority of the public doesn't want fully decentralized, fully libertarian ways to invest. It demonstrates that crypto is playing a really important role. It's not disappearing. It's expanding, hopefully, the realm of financial services and investment opportunities available to us all. And it's also demonstrating that regulators need to intervene. It's part of how healthy markets grow and how new technologies become adopted safely. If there was still a lot of frustration with regulators, concern about regulators getting involved, there is a bit of a libertarian core in the crypto ecosystem. I think those voices, are much hard. Those points, are just significantly weakened after everything that happened. Especially because a lot of people in the crypto industry are frustrated that what happened with FTX wasn't even necessarily about crypto, right? It was just irresponsible corporate governance. It was like something between WeWork and Theranos and Madoff, right?
Right.
So there are questions like, what's going to be the Sarbanes-Oxley of crypto? How are those standards going to be applied? Obviously, what kind of consumer protection requirements are going to be there? How are regulators going to look at DeFi, which is, it's important to separate, right? You have crypto, CeFi, which at this point people are quite aware, quite familiar with, regulators understand, and then you have DeFi, which is a completely different infrastructure, right? So I think generally over the past 5 years, and especially after FTX, the excitement has grown for regulators to get involved, and we'll be seeing, throughout the year, we're going to be seeing, MiCA, markets in crypto asset regulation in Europe, which is going to be very important. A bunch of bills that have already been introduced in the US, Loomis Gillibrand and the Stabenow-Boozman bills. And, there are already places in the world where these are already working as licensing regimes. So, bottom line, for someone like me who's really here for the long-term value, and I think there are a lot of us here, it's a very great, it's at the end of the day, there are things to be excited about. I'll also say, really important to remind people that when you look at surveys, at numbers, statistics, there's still a lot of institutional interest. Fidelity Digital Assets, still places around 80% of investors that they surveyed as being very interested in expanding crypto exposure. You're seeing adoption on the mainstream side as well. I'm not necessarily saying there's going to be a huge bull run this year, but there are a lot of reasons to keep looking at this industry and look for the right opportunities.
Yeah, and I think that's a good point, Chen, on the crypto regulation front, because at the end of the day, crypto is always going to have that kind of libertarian, enthusiastic core, from its people that really truly believe we don't want money from the government. We want our own money, and we want it to be decentralized. And they want no regulation whatsoever. Or there will be some people that see any sort of regulation as bad. But like you said, that argument kind of weakens the more and more you see things like FTX. And I think people, like everyday, Americans or Israelis that might, deposit some money and buy crypto will feel safer doing so when they know, their money is not going to fund, Sam Bankman-Fried in the Bahamas. It's going to actually buy that cryptocurrency they're trying to buy. So I don't, necessarily think all regulation is bad. I think some people will be happy to see some come. And like you said, maybe this year, after everything that happened last year, is finally the year that you do see some of that regulation come in. So
yeah,
it'll be interesting to see.
And I think it's important to say there's been such a process of dichotomization. Is that a word in English? I think it is.
Yep.
Dichotomization. Well, as long as you get me, Aaron. There's such a process of dichotomization between crypto and traditional finance. But in reality, if you look at traditional finance, you have more regulated and less regulated areas where you can decide where to play. You can invest in securities, you can invest in penny stocks, right? That are kind of more inviting for slightly, let's call it, less conservative approaches. So you're seeing that happening in crypto as well. At the end of the day, the way I believe that decentralization is a binary. It is a spectrum, not a binary. It's not either or. The role of crypto and decentralized finance is to expand the realm of available opportunities we have, all of us have, and to expand it to more people simply because they're open, decentralized systems. But it depends on making them safe, because the fact that something is completely open doesn't mean that it's accessible if my grandmother can't invest in it without getting hurt, right?
Right. Well, Chen, thank you for coming on the show today. I wanted to have someone from the crypto industry come on and talk, give an update of what the sentiment is in the industry. I know it's probably late for you over in Israel, so thank you again for hopping on with us today. Would love to get you on again in the future, but we are running up on time here. It's 1 p.m. Eastern, which means it's time for us to end the show, unfortunately.
No
but again,
worries.
Can't thank you enough for hopping on the show. I'm going to go ahead and drop the link.
My pleasure.
To
Thanks
Solidus.
for having me. It's a pleasure, and I'd love to come back. And most importantly, engage crypto. When you engage with crypto, make sure you deal with platforms that care about your safety, that have risk monitoring, etc. And please feel free to reach out. Read our recent rug pull report, which I think really speaks to the opportunity of open finance. We're literally able, because when scams are on a blockchain, you can detect them the moment they're coded into it, but also the challenge. A new scam is created every 4 minutes. So anyway, it's going to be a very interesting year in crypto for us, and I believe for everyone else. Would love to come back, Aaron. Thanks for having me.
Isn't it always an interesting year in crypto?
Until, that was the case with all new technologies, until at some point it becomes old news. But I think we have between 10 and 50 years for that to happen.
100%. All right, Chen, well, thank you again. We'll chat soon.
Pleasure.
All right, everyone, it is 1:03 p.m. We're running up against the clock. That means it is time to end the show. Money Mitch, Stock Market Movers will be coming up. You do not need to go anywhere. This stream will automatically redirect you to that show, so just stay tuned. Money Mitch will be talking to Michael Lee, the founder of Michael Lee Strategy. So should be an interesting interview on Stock Market Movers. Without further ado, let's go ahead and turn it over to Mitch. We'll be back tomorrow, 11:30 a.m. Till then, stay green, guys. Peace and love, y'all. Whoa, where's my...